What I'd like to try and talk about tonight is answer one question, and is this recovery sustainable? And the answer may not surprise you, but we will arrive at an answer at the end. To do that, I'm going to go through a macroeconomic perspective to give you an overview, something about the capital markets, because ultimately that's what it's about, the capital markets and how the macroeconomic perspective is reflected, and then also what the relevance of that is to your investments. But before we go on, I'm going to share a little insight with you. I like doing these presentations. I've done a lot of them over the years, but I've learned the danger of using analogy. And I learned it when my 5-year-old daughter, Charlotte, asked me to come to take your parent to kindergarten day. The night before, we talked, and I said, Charlotte, I'm going tomorrow. What are we going to do? Well, I have to tell the class what you do for a living. So I said, do you know what I do? And at that time, I was working with clients. I said, I'm an investment counselor. And she looked at me with that blank stare that a 5-year-old could look at and said, I have no idea what you're talking about. So well, let me try to use an analogy. When you're sick, we take you to a doctor, and the doctor helps you get better. When people's money is sick, people take it to me, and I help their money get better. Does that help you to understand? And she looked up, and she smiled. Paid her it. She understood what I was talking about. So the next day, I'm standing at the back of the class. Charlotte goes up to the front, walks up, and the teacher says, Charlotte, who's with you today? My daddy. So I walk up to the front. We hold hands at the front, and the teacher says, and what does he do for a living? And she said, he takes money from sick people. So with the danger of analogy in mind, I'll venture on to how, looking at the markets today, we've been following over the last 18 months 4 factors that are critical for a recovery from the recession we've just been through. So to start off, you can follow in your sheets if you want. We're going to look at U.S. housing markets, the U.S. consumer. We'll look at the U.S. banking system stability, and the global credit markets. Now, the last point would have been somewhat interesting a month ago when I was doing these presentations. Since last week, it's become extremely more interesting than it was before. But before we do that, I'd like to take you on a little ride to London. And imagine a Friday afternoon in London, a young banker, Henry Thornton, is waiting for the bank doors to close because there's been a run on his bank that day. The doors close. If they have enough money when the doors close, the bank can stay solvent until Monday morning. And in fact, that does happen. The bank stays solvent for the rest of the day. Henry gathers the forces at his disposal, goes to the Bank of England over the weekend, and manages to get a $4 billion equivalent line of credit to float the bank Monday morning. Bank opens up Monday morning. The run stops by the mid-afternoon because everybody's confident they're going to get their money back, and Henry has achieved his goal. Now, this may sound like an interesting story, but it becomes a little more interesting when you know the year. And the year was not 2008, it was 1825. So this is probably the first instance we have of a central bank intervening during a banking crisis, or the crisis of a bank. And for those of you who are liberal arts majors or have studied liberal arts, we owe the knowledge of what Henry Thornton did to E.M. Forster, the English novelist. He passed this on to us by virtue of having edited his great-aunt's letters and diaries, because she bequeathed him a sum of money that allowed him to become one of the foremost novelists, English novelists of the late 19th, early 20th century. So think of Henry Thornton, 1825, having to float a bank, and we're still going through the same things today. So what we're seeing today is not necessarily new, but it's not necessarily good either. So what's the macroeconomic perspective? I'm going to take you through this fairly quickly because I'd like to get some time at the end to talk about Greece and its friends, and also about Goldman Sachs. Greece has kind of taken over the headlines over the last week or two. Goldman Sachs is going to come back. And J.P. Morgan's going to be with them now, we read today in the Wall Street Journal. What we like to follow are things that are going to give us a better idea of what's going on in the future. we're dealing with uncertainty. The investment markets are about uncertainty, so we're trying to get an idea of where things might be going. Leading economic indicators are one of the things that we follow to get an idea of where things are trending. The blue line you see is the leading economic indicators. The flatter red line is the coincident economic indicators. So what it shows is there's a fairly good gradual trend of those indicators that are typically going to help us understand whether a recovery is here. What we like to do, though, is go the next level and say, what are the component aspects of leading economic indicators? A little small to read on the slide here, but you've got it in front of you, and you can see how this changes over time. The left-hand side shows how the factors influenced leading economic indicators a year ago, March, and what they did this year in March. So you can see that the top bar is what leading economic indicators changed, but the other 10 bars show the different factors that influence leading economic indicators. So it's important here to see, if we look at the top two, consumer expectations, which I'm going to spend some more time on, but interest rates being one of the major contributors to leading economic indicators rising. Interest rates are low. That gives us an idea that perhaps there's more of a chance for recovery. The point here is we're looking a little beyond just what we're reading in the papers about leading economic indicators, trying to find out what's going on behind that. What are the component aspects that are important? If we're looking at a recovery and look at the IMF, the International Monetary Fund, gives us an idea by projecting out over the next, up to 2014, so they did it last year, for the next 5 years, and look at global economic growth on average to be around 4.2%. Many of you will have read, of course, that includes countries like China and India that are going to grow at quite high rates, probably a lower rate for most of the developed economies, but still at a 4.2% rate after a drop in 2008. But if we're looking at the US, we don't see it as quite, and this is again International Monetary Fund figures and projections, we don't see this as being quite the same in current terms. So we see that at the end of 2009, so the second bar from the right is the fourth quarter 2009 growth, which was at 5.6% adjusted. The first quarter of this year dropped to 3.2%. Now that's annualized, so quarterly but annualized. So what we're seeing is, and what I'd like to show here is, it's not a trend yet. So again, the question we're looking to answer is this a sustainable recovery? When we look at GDP, we try to go, gross domestic product, we try to go a little further to say what are the major components, and then even further to look at the balance sheet the Federal Reserve Board puts out to let us know what the component parts are. But here for you, I've put a slide in that shows you what the major components are that we follow. And if you remember from Economics 10 or 101, GDP components are primarily consumption, private investment, government expenditures, and net imports. What's key here is consumption. If we look at gross domestic product in the US, 70% of US gross domestic product is driven by US consumers. So the thesis I'll put before you is, without a full recovery of the US consumer, we don't have a full recovery of the economy in general. But we still follow these other factors. So what we're looking at here is what happened on the right-hand side in the first quarter 2010 versus the first quarter of 2009. We see a growth, the top bar, this is in dollar terms, a significant growth. Most of it is coming by an increase in consumption. So that, again, is part of the thesis that there is somewhat of an inkling of recovery coming, but we need that amount to be much larger. The US economy is $14 trillion. So of that, about $9 trillion is the US consumer. So this amount, the 379 billion, is not significant in that sense. It's growth, but we've got a long way to go. And what I'm going to take you to next is, if you looked at what growth would mean, growth has as an accompanying factor an inflation capacity, or capacity to introduce inflation into the economic equation. What this graphic shows you is the last recession before this gray area is recession, and the previous recession after the dot-com bubble was very brief and short. And I'll dwell on that a little at the end if we've got time about balance.